LPs are most likely to actively manage their private portfolios, my experience, when a new CIO comes in. What can LPs do who maybe were around when the decision was made to invest with a manager do to think about being more active, challenging their biases when it comes to the hold or sell decision for tail end funds?
If you look at the history of the secondary market, Hillary, if you go back 20, 25 years ago, most of the secondary activity was done by banks and insurance companies. You recall the banks were forced to get out of funds as a result of some regulation changes. And LPs felt being an active user of the secondary market may be a bit frowned upon by their managers. You fast forward to today, LPs are using the secondary market. GPs are using the secondary market. It is an important tool for portfolio management, particularly in light of what I said earlier, that private equity is not a rounding error in most institutional portfolios these days. So they have to be engaged with their managers. They have to be thinking all the time about where the performance is coming from and focus on the part of the portfolio that may be a drag to them. And consistent with what Eric said earlier, not wait until 10, 15 years to have a conversation with managers that are underperforming, but have that conversation at year 4 or 5. And if they feel like there is a misalignment or underperformance or that something needs to happen, they may want to take a more active role in monetizing those positions in the secondary market, or candidly even having a discussion around resetting economics incentives with the manager. Or finally, if it's really problematic, consider options of perhaps even a GP transition where they can realign their interests and ultimately either maximize value, mitigate risk, and certainly get money off the table in a more timely manner.